Item 10D, receive a quarterly financial report as of March 31st, 2011 for fiscal year 2010, 2011, general funds, special revenue funds, enterprise funds, and internal service funds.
Good evening, Mr. Mayor, members of the City Council, Edmondson Finance Director. This is a quarterly financial update as of March 31st, 2011. The first slide identifies some of the major revenue categories for the general fund, so I'll go over each one of these items. In the category of property taxes, we're currently at, through the first 9 months of the fiscal year, we're at 58% of the full year budget. Property taxes are primarily paid in 2 large installments, that being in November and April of the fiscal year. So in these results, obviously, we have not included, does not include the April large installment. There are also some small payments that are also made during the course of the year. So at the end of the fiscal year, staff is expecting that we will be close to either meeting the level of the budget or very close, maybe a little bit, a tad behind the full year's budget, but certainly, you know, within, relatively within the range of the $5.6 million. In the area of sales tax, we're at 72% of the budget, compare very favorably to the prior year's results. A couple of key elements of the increases include a one-time credit of a misallocation of sales taxes of $140,000. The state's correction in terms of in lieu sales tax via the triple flip. And then I think generally recovering economy that's led to some improvement in terms of retail sales overall. Third category is in the area of vehicle license fee, and that's right at the 50% mark. This is actually primarily paid by the county, and again, 2 installments, November and April there. In the area of charges for services, we're right at the 75% mark. Moving on to uses of money and property, the primary source of that is actually investment interest income. And with interest rates and yields continue to be very, very low, we're obviously behind in terms of where we are at this point in time. And staff does expect that by the end of the year, we're not going to, be able to hit that $2 million mark, probably in the neighborhood of about $200,000 to $250,000 below that mark. And then lastly, in terms of the major categories, transient occupancy tax. When we budgeted for this category at around this time last year, the economy was still facing some difficulties, and we budgeted very conservatively. And with the improvements that we've seen, that's actually been a very pleasant surprise in terms of comparing to where we budgeted. So we're already at 87% at the 9-month mark, with 3 months to go, plus an extra month because the TOT taxes are received 1 month in arrears, so there's actually 4 months to go in terms of TOT revenue. So that category is obviously doing quite well compared to where we budgeted. In terms of expenditures, overall, we're at 73% through the first 9 months. In terms of anomalies, the only one that really stands out was really in the category of engineering and streets, and that's really more of an accounting function. There are staffing charges that we make on the accounting side to charge staff time against CIP projects, and that hasn't been done yet, so it's a little bit misleading in terms of where that level is. Once we book that entry, we'll reduce those expenditures accordingly and charge them out to the various CIP projects. Moving on to, moving out of the general fund, actually, I should go back to the slide here. In terms of overall results that we expect for the balance of the year, we think that we will be running short about $400,000 in terms of revenues compared to expenses. Now, this is comparatively favorable to what we did when we did this budget. We're expecting a $900,000 gap to be made up in terms of using limited term revenues, that being use of excess ERAF and then repayment from the redevelopment agency to the equipment reserve fund, which in turn would then transfer that money back into the general fund. So with this picture in mind, what we're proposing, and we identified that at the February study session, is that in lieu of using those two limited term reserves, we would then use the excess revenues or the better than expected revenues from the current picture, and then the rest would come from fund balance that we've accumulated from the prior fiscal year. So moving on to redevelopment agency, the revenues for both the operating fund and the low and moderate income fund, again, are also tied into the payments that we receive from the county, and therefore we're just above the 50% threshold. In terms of the expenditures, they're substantially lower than a linear calculation, and the reason why is in the operation side, the pass-through payments that are made are typically done toward the end of the fiscal year, and that works out to be about $3.3 million. So obviously most of the expenditures for the operating fund, redevelopment agency operating fund that is, doesn't occur until the latter part of the fiscal year. It's not reflected in the third quarter numbers. Similarly, in the low and moderate income housing fund, we've only spent about $400,000 out of the $1.4 million. And again, there's an element of expenditures that doesn't occur until the fourth quarter, and that's the subsidy that we provide to Archstone, and then again, that's made toward year end in the fourth quarter. So that amount is about $680,000. So again, a substantial portion of the expenditures in this particular fund doesn't occur until Q4. In the enterprise funds, as was just discussed, in terms of the cable television enterprises, due to the loss of subscribers, we're not expecting to be able to hit full year revenue targets. Likewise, on the expenditure side, as we add subscribers, there are some incremental costs associated with that. So really at the end of the day, we're going to see revenues that are not going to hit the budget numbers. Likewise, on the expenditures, we're not going to be spending the entire $10.8 million as budgeted. In the other, in the public services enterprises, if I may, in the wastewater, water, and storm water, the revenues there are, at least for wastewater and water, are running a little bit lower than what we would normally see, and I think much of that is partly attributed to just lower consumption that we're seeing for the fiscal year. In the area of the storm water enterprise, that's actually through assessments, so it's part of the property tax bill that the assessment is added to. So again, we've only received partial payments from the county on that. So in this particular category, we do expect that we will be able to hit the budgeted revenue mark of $597,000. So looking ahead, staff is working on preparing the 2011-12 budgets, and a couple of elements that we're looking at, continued costs that we're dealing with in terms of PERS retirement. The impact to the general fund is about $644,000 due to the rate increases that we've been provided by CalPERS. So overall, we're looking at somewhere between the $950,000 to $1 million mark in terms of shortfall. we discussed that at the February budget study session, and consistent with those discussions, the plan is to use, again, limited duration revenues to close that gap, and that, again, being undesignated fund balance. We also have recovery of permit fees that we're expecting from PG&E for the Glenview rebuild, and then leftover balance, we would then go to excess ERAF as the option. We'll be coming back to City Council with budget study session scheduled for early June to talk about the recommended budget. So as staff continues to complete that process, we'll bring that item up to City Council to identify those specific dates for the budget study sessions. With that, I'll take any questions, and the recommendation is for the City Council to receive this report.
Good. Any questions?
To the
Ken?
Chair. Edmund, you explained clearly as far as the property tax revenue, and that we haven't received it yet. And then you give these dates from 2009, 2010. Are those the same type of numbers? I mean, is there any comparison to those numbers that that we see in 2009, 2010, as compared to what you're seeing now?
Yes. So in looking at this side in terms of property taxes, in 2009-10, through first 9 months, we were at around 3.279 compared to where we are for this current year. So it's relatively comparable.
Okay.
So yes, we're measuring the same time period.
So along those same lines,
yes.
I realize we have 55 homes.
Correct.
Whose property values have significantly been reduced. Is there any talk, can you talk about how that's going to reflect in these figures, and quite possibly in the coming
yes,
term?
the potential impact is more likely for the following year. When the tax roll was conducted, this was measured as of January 1st, 2010. That's how the county measures the values. They freeze the date, so to speak, and say, okay, where are the assessed values as of this date? So for the next budget, they're going to be using January 1st, 2011 as the measurement date. So potentially the impacts would then be for the subsequent fiscal year in terms of potential impacts in terms of property taxes.
So that's significant, isn't it? Or do you anticipate it being significant?
Yes, there's definitely a value associated
short term,
with that.
at least.
And what I would say is that in terms of those loss of revenues, that's an element that we can go to PG&E as part of the reimbursement process, because included in that whole concept is not only what we incur in terms of expenditures, but also included in there is the notion of lost revenues. So this would fall within that umbrella.
Thank you.
Any other questions? Ed? All right, thank you for the report.